So selling options often generates high success rates with a greater number of positive trades. However, sometimes the individual downside risk can be significantly larger than the upside winners. Do you know why that is? Because when you sell options, you have limited profitability with unlimited risk. So it's not like it's some kind of, hey, this didn't work or whatever it is. This is really simple math. You can only make what you sell, but you can lose an unlimited amount. Therefore, you have high success rates. And you can see all the green there is your success rate, but the red's where it gets a little ugly. Today, we want to explore the magnitude of these large downside risks in the worst case scenarios. One method to measure losses is to utilize the loss to credit ratio, which involves dividing the loss by the credit received. All right? We're trying to loss to credit ratio, dividing the loss by the credit that we receive. So we conducted an analysis of a 45-day expiration SPY strangle, one standard deviation out of the money. We recorded the loss to credit ratio from all the losing positions over the past 2 decades. All the positions were held to expiration. So could we have reduced the size of these losses? Absolutely. We would have eliminated most of the large losses by managing early. But for the purposes of this, we're going to let everything go because we're going to give you kind of like, this is going to be like a worst case. The majority of the losing positions exhibit a loss to credit ratio smaller than 1, indicating that most losses are less than the credit received. Rarely does the ratio exceed 3x. So that means in most one standard deviation strangles, when you lose, the majority of the losses are less than the credit you receive. There are going to be some outliers, but that's that's your C-bar and everything else. But generally speaking, most of your losses are inside a ratio of 1.
And those are the ones you'll never remember. The other ones at the top of the page there are the ones you'll always remember.
And if you manage early, you get rid of most of this stuff. So over the long term, the median ratio is only 1, meaning that half the occurrences experience a loss similar to the premium received, which is much lower than expected. When you look at it this way, it's very different. Loss to credit ratio, the median is only 1, but the high is 27. So apparently, the worst losses occurred in 2008, 2018, and 2020. As we delve deeper into the difference between those years, we've also included 2022 in the comparison as the most recent market correction. So 2008, 18, 20, and 22. So although 2008 experienced the largest market pullback, the largest losses were actually in 2020 because it just happened so fast. In 2022, we observed a larger correction than 2018, but the loss ratios were similar. So again, we're just presenting kind of the largest pullbacks in percentage terms in the S&Ps, and then the loss to credit ratio, what's the largest and what's been kind of the median. I don't know, any conclusions that you can draw from this? I mean, obviously 2020 happened really fast, that 35% drop in the market.
I mean, this is looking back. I mean,
Yeah, these are the largest losses.
What do we usually have a correction like every, 6 to 7 years or something like that? And we haven't had one in 10 or 12 years. So, I mean, when you look back, you only can decide on what may happen in the future, but it's very hard to play for it. Yeah. I think size is the most important thing with all of your positions.
Well, it's interesting because, we haven't really had a pullback in a long time, and 2 years. No. And so when you look at the size of the pullbacks on the right-hand side of the page, you're like, wow, we haven't seen anything like that. 48%, 19%, 34%, 27%. Right. We can't even get 2%.
Right.
We haven't had 2%. So we're just putting this out there because we don't want anybody to be shocked if you get a 5, 10, 15% pullback, and the loss to credit ratio is, whatever, some multiple of 1 that could be between 5 and 10. I don't know.
Sure.
I mean, you can't take these out of the equation, altogether. There are 2 reasons behind these findings. First, the primary catalyst for substantial losses is the rapid decline in market price, which leaves traders with insufficient time to defend their positions. And second, the largest losses have consistently occurred when the positions were established during calm market conditions, just like now, and low IV, followed by a sudden surge in the VIX, as was the case in 2020. So all of these situations happened from a very calm marketplace, not from an active marketplace, which is important to note. So the magnitude of market corrections does not necessarily correlate positively with losses from selling options, as shown by the comparisons between 2008, 2020, and 2018 and 2022. Traders need to pay close attention to the option positions when the market keeps making new lows and IV is low. Keeps making new highs when IV is low, which does not provide a rich premium for premium sellers, making it all the more dangerous in those cases. Yeah, I guess that's, it's just there to point out kind of the magnitude of the move on large losses and kind of where they come from, levels of volatility.
Very good. And we realize that most of these moves come when the volatility is very low, which we've had over the last, couple of months.